Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Was it all just a dream? Businesses and investors are bracing for, you guessed it, uncertainty, says the New York Times, after Supreme Court justices 217 days after Tariff Day questioned the legality of part of the administration's strategy of imposing tariffs under the Emergency Powers Act. Currently, the Yale Budget Lab says the average effective tariff rate is 18%, and if tariffs imposed under emergency powers are invalidated, the rate would be 9%. One more bit of information to contribute to volatility. More on this in a bit. This week, our three things are: 1. Private credit color. Two big lenders weigh in with what they are seeing. And 2. Reduced uncertainty. Wait a minute, there's plenty of uncertainty, right? We'll explore. And 3, consumer belt tightening. It's spreading. All right, let's dig a bit deeper. Private credit color. So this week we got earnings from two private credit titans, Apollo and Ares, with much anticipated color on what they're seeing in their credit businesses. Apollo dispelled the notion that recent high-profile credit deterioration represented something systemic. I don't think we're talking about systemic risk, said CEO Mark Rowan. I think we're talking about late cycle behavior and bad actors, which are going to get called out. That said, he rhetorically asked, are things cheap? Resoundingly no. Do we think rates that matter, long rates, are going to plummet? We do not. We think that most of what we're doing in the world is actually inflationary rather than contributing to lower rates. And finally, do we see enhanced sources of geopolitical risk? We do. As a result, Apollo characterized its positioning in the following way. The logical thing to do is to take risk down. That's what we are doing as a firm. That's what we are doing for our clients. President Jim Zelter added, isolated incidents are nothing new, and they're rarely a signal of broader stress. As we remain vigilant in our underwriting and risk management efforts, what we're seeing is idiosyncratic, not systematic. Over at Ares, similar sentiment. CEO Michael Arougheti said, based upon the strength that we are seeing in our portfolios and what we are hearing from our peers and general credit trends, these high-profile bankruptcies and instances of fraud appear to be idiosyncratic and isolated and not the sign of a turn in the credit cycle. From our vantage point, our credit portfolios also remain healthy, and we're not seeing any deterioration in credit fundamentals or changes in amendment activity that would indicate a turn in the cycle is coming. He added, from a fundamental standpoint, we continue to see healthy year-over-year double-digit EBITDA growth across our U.S. direct lending strategies, and interest coverage ratios are improving. We're not seeing a material change in loss curves relative to our underwriting estimates. This is all consistent with our view. As we discussed last week, the most important takeaway is that investor concern over these situations ensures that every lender is going to go back into their portfolios and scrub for any weakness, and tightening underwriting standards on new origination. There is a cost to this, slower growth, but ultimately credit market performance will be the beneficiary. All right, on to our second thing, reduced uncertainty. On fundamental factors driving credit, there is disagreement. On growth, bulls say, look at the Atlanta Fed GDP now. Q4 real GDP growth is modeling toward 4%, and you've got more fuel in the form of rate cuts and big, beautiful bill stimulus on the way. Bears would say, strip out tech capex and the spending of the wealthiest households, and growth is below 1%. On the labor market, bulls would say, unemployment is well below long-term averages, and the Boston Fed says we only need as few as 35,000 jobs a month to keep it that way. Bears would say, growth in non-farm payrolls has dropped to near stall speed, and AI will drive unemployment higher. On inflation, bulls would say, strip out one-time inflation effects, and core PCE is down around 2.3%. Bears would counter, we're 50% above target, tariff effects have yet to be fully felt, and immigration limitations will pressure wages. And then, of course, we are now facing vulnerability in the administration's tariff strategy. Well, it seems like we still have a lot of uncertainty hanging over the economy. But let's think about that for a minute. Trade policy uncertainty has come down significantly, So says Bloomberg Economics Trade Uncertainty Index, which has fallen back to December 2024 levels. And it's worth remembering that the effective tariff rate is coming in meaningfully below the headline rate due to negotiated carve outs. According to the Tax Foundation, as of November 1st, the weighted average applied tariff rate on all imports rises to 18%, but the effective tariff rate, reflecting behavioral responses, is 13%. Now, we don't believe tariffs are going away, but they are settling into a range that is more easily adjusted to, allowing businesses and consumers to plan with greater certainty as trade frameworks with key trading partners have already been dimensioned. What about interest rates? Well, back when markets were speculating that we could have 6 or 7 cuts, it was difficult for businesses and consumers to plan. Now we know with greater certainty that we're looking more realistically at 2 to 3 cuts by year end 2026. There is less concern over moving forward with investment plans, knowing that rate cuts ultimately will not be all that material. And growth estimates have firmed up around potential. Both the Bloomberg and Fed consensus for 2026 growth in real GDP is 1.8%. And 1 year recession probabilities, again, Bloomberg consensus, have come down from 40% in April to 30% today. So, yes, there is plenty of points of uncertainty out there. And maybe that causes equity analysts, where valuations are priced with very little room for error, to worry. But for credit, the improvement, the reduced uncertainty, just might make either scenario, bull or bear, good enough to keep the investor bid strong. All right, on to our third thing, consumer belt tightening. So we've long talked about two economies, now widely referred to as the K-shaped economy, one where wealthy households and larger businesses are doing well, while less wealthy households and smaller businesses struggle more to absorb inflation and tighter credit conditions. We got more anecdotal evidence of the struggle less wealthy consumers are facing this week with disappointing earnings from Cava on the back of similarly disappointing results last week from Chipotle and Starbucks. The results square up with age 20 to 24 college graduate unemployment, which has reached the highest level in a decade. So belt tightening and trading down has been something we've seen evident in Walmart and Target stories going back to peak inflation days in 2023 and 2024, and it now appears that the trend has legs, hitting those that had grown accustomed to affordable luxuries, such as $20 lunch bowls and double meat orders. With student loan payments back in the mix and growing concern that the jobs market is tightening, something, by the way, seen in the most recent University of Michigan and the Conference Board consumer sentiment surveys, we get a sense that the less wealthy consumer continues to rein in spending. The trend clearly has read-across implications for consumer-oriented businesses, both staples and discretionary categories, such as travel and leisure. In a world where the top 10% of household earners account for 50% of spending, there is no reason to sound the alarm bells when thinking about aggregate consumer spending. But with equity markets priced historically high and vulnerable to correction, by the way, the heads of JP Morgan Chase, Goldman Sachs, and Morgan Stanley have all acknowledged as much. And the negative wealth effect that goes with that possible correction, you now have headwinds and vulnerabilities building across much of the consumer landscape. So there you have it. 3 things in credit. 1, private credit color. Idiosyncratic seems to be the word of the day. 2, reduced uncertainty. It's much better than March, April. And 3, consumer belt tightening. Expect to see more of this. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. And finally, for those interested in what's going on with banks, you'll want to attend our KBRA Bank Symposium one day, November 19th, at the Willard Hotel in Washington, D.C. Our keynote address will be delivered by political pundit Jim VandeHei, co-founder and CEO of Axios, who just published a worrisome note on the impact of AI. You'll want to hear that. To learn more or register, visit kbra.com/events. We'll see you next week.